Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. And you can pick up Market Masters at any bookstore. You can go to Indigo, Kohl's, Chapters if you're in Canada, Barnes & Nobles in the United States. You can go online, Amazon.com or Amazon.ca. You can pick up my book, Market Masters, there. So today I'm going to be talking about capital compounders. And some of you might remember a video from last year, and that was the first list of 25 capital compounders. And now I've added another 15 capital compounders for a total of 40 capital compounder stocks. And the way I define capital compounders, these are companies that achieve a very high and consistent level of return on capital. They're run by exceptional owner-operators or CEOs who are just amazing at allocating capital. And these are companies that still have a long runway to grow. There's still reinvestment opportunities to grow organically, and some of these companies also acquire and consolidate within the fragmented industry that they're in. So just a little bit of history. Last year, I was giving a speech at the annual Fairfax Financial Shareholders Meeting. And it's a company run by Prem Watsa, who's known as the Warren Buffett of Canada. It was an amazing opportunity. And that's where I presented for the first time, these 25 capital compounder companies. Some of them are Dollarama, led by Larry Rossi, Constellation Software, led by Mark Leonard. And another example, was Stanley Ma, who runs MTY Food Group. And these are just 3 of the 25 that I presented there. And I turned the speech, Capital Compounders, it was pretty popular, into a mini book, Capital Compounders. If you email me, I'll send you a free copy. I posted a video about it on YouTube. If you type in Capital Compounders, you'll find it. If you go to my website, robinspeziale.com, you'll see my entire write-up based on that speech that I gave at the Fairfax Financial meeting. You'll see the whole speech there that you can read. And it was a great experience. And these companies, I showed they beat the TSX in the long run. And the TSX has achieved about a 9.8% compound annual return over 50 plus years. And these companies, though, since inception on the stock market, they've achieved over 20% compound annual return. And so there's a couple of reasons why. And the reason why is because these 25 original compounders and these new 15 stocks we'll be talking about share these same characteristics, and they're the following. These are mostly small and mid-cap companies. So they're companies that range from 100 million in market cap to 10 billion. And they're in the non-cyclical technology, consumer, and diversified industry space. And they also have these large addressable markets with long growth runways. Also, these companies are all free cash flow generative. They're generating high free cash flow, but they're also high return on capital businesses too. So they have a high return on invested capital, and there's a durable moat too. So they keep away competitors. They're run by exceptional operators and shareholder-oriented managers who effectively deploy capital in reinvestment opportunities to grow the business. And this is very important, right? So a lot of companies are either too big, there's not enough growth opportunities, and they're just paying out a dividend, right? They're not redeploying capital back into the business to grow. There's not that growth potential anymore. And what a lot of these companies, the 25 then and the 15 now, that I'm adding in the total pool of 40, they also acquire companies in a fragmented industry, and they're very good at that. And they're continually delivering high returns for their shareholders in the stock market. So in that first speech last year, what I said is that I like to think that there's a strong correlation in the long run between a company's return on capital and its share price performance. The average return on capital of those 25 capital compounder stocks was 16%, and that was over a 5-year average. I don't want to see a company that just, has a 16% return on capital this year, but then, maybe a 5% next year and a 2% the year after that. It has to be consistently high return on capital. And the average compound annual return on the stock market since trading inception of the TSX of these 25 companies was 26%. So there I showed, there's a pretty strong correlation in a high return on capital business and the return that it can generate over time. Um, it's now been over a year since my talk on these 25 capital compounders, and so I wanted to gauge their stock performance over that period. So from April until now, until July. So it's April 2017 through July 2018. The results were definitely satisfactory. In aggregate, the 25 capital compounders achieved a 15.8% return from April 19th, 2017, all the way through June 2018, easily beating the TSX composite, which is only up 4.7%, and ranking closely alongside the S&P 500, which is up 17%, and the Dow Jones Industrial Average, which is up 19%. So clearly, these 25 capital compounders, all Canadian companies, beat the S&P TSX, right? 15.8% versus the TSX 4.7%. Now, it's encouraging to see that year to date, so that's just from January this year through June, this basket of 25 capital compounders is up almost 6%. That was ahead of all three comparison indexes. The TSX composite was only up 0.4% this year. S&P 500 was only up 1.7% this year, and the Dow Jones Industrial Average is only up. Well, actually, it was down 1.8% through June, year to date 2018. And I'm going to name these 25 capital compounders from last year. And again, go to my website. If you go to my blog on robinspeziale.com, you'll see the year-to-date track record of these companies, the original 25 capital compounders, and their 2017 to 2018 return. And these companies are Polar Banknote, Constellation Software, Photon Control, Logistec, TFI International, Enghouse Systems, Premium Brands, Dollarama, Lassonde Industries, Stella Jones, Brookfield Asset Management, Canadian National Railway, Savaria, CCL Industries, Metro, Two Cows, MTY Food Group, Gildan Activewear, Saputo, New Flyer Industries, Stantec, Alimentation Couche-Tard, Richelieu Hardware, Computer Modeling Group, and then CRH Medical. Now, I just want to note that among these 25 capital compounder stocks, some are very big companies like Brookfield Asset Management, and you shouldn't expect these big companies to grow, very rapidly anymore. Law of large numbers, you can't go from 50 billion to 100 billion to 200 billion very rapidly within a couple of years. But all these companies, if you look back historically, the past 10, 15, 20 years, have just compounded capital at such an amazing rate. And what I want to do now is share the additional 15 capital compounders that I'm adding for a total of 40. And these, this new 15 group of stocks, which I'm supplementing here, they're all either small cap, so 100 million to 2 billion in market cap, or they're mid cap stocks, which is 2 billion to 10 billion in size based on market capitalization. And these 15 stocks, again, they all share the same metrics. They're high return on capital, consistently over time. They're run by exceptional managers. These companies still have ample investment opportunities. On a trailing 12-month basis, these new 15 companies in aggregate have achieved a 17.2% return on capital. And over the last 5 years, a 15.9% average return on capital among these 15 stocks. Now, their return in the market since inception on the TSX, they all IPO'd at different times, but on average, 23% compound annual return. Their average public life is 14 years. Interestingly, 5 of these new 15 companies have achieved a compound annual return that is greater than or equal to 30% since their inception. So that's Kinaxis, which has a compound annual return of 61% on the market. Spin Master, compound annual return of 47%, and First Service, which has achieved a 43% compound annual return since it started trading. The newest companies out of the 15 with only 3 to 5 years of public trading on the TSX are Spin Master, Fairfax India, Sleep Country, First Service, Kinaxis, and BRP. Some companies like Transcontinental have a much longer tenure in the stock market, but at this time are transforming their business models for future growth. And so one might expect, again, this is a big maybe, the future isn't told, they might expect future higher compound returns from this point on. In Transcontinental's case, they're transforming their business from traditional newspaper / printing to shipping and packaging for the e-commerce age. Other are larger companies like Magna that are diversifying into new investment opportunities like in artificial intelligence and electric vehicles to drive their next growth phase. However, the majority of companies that I'll be talking about, this is the next 15 capital compounders, again, they all fit into the small and mid-cap space. They have large addressable markets and they still have long runways to grow. So here's a list of the next 15, I call them. But again, I'm combining these 15 with the original 25 to make 40 capital compounder stocks in this list that I'll be tracking in my newsletter that I hope you subscribe to. So Spin Master, BRP, Silogist, Texas, Callion Group, Transcontinental, Sleep Country, Magda International, Kinaxis, Fairfax India, CGI Group, Great Canadian Gaming, First Service, CIE, and Andrew Peller rounds off the list of 15 companies. So I'll track these 40 capital compounders, the original 25 plus the 15 here, for the foreseeable future, and I'll always be on the lookout for more. Email me your suggestions or comment in the video. As Peter Lynch said, Peter Lynch wrote One Up at Wall Street. He was running Fidelity's Magellan Fund for years, 13 years, achieved a greater than 20% compound annual return. Peter Lynch said the person that turns over the most rocks wins the game. In other words, try to discover as many of these smaller companies as you can. Overall, if I achieve a 15% compound annual return in my portfolio over the long run, then I'm a happy guy. Striving for anything over 15%, and honestly, in my opinion, I'm taking on too much risk, and that can blow up my portfolio. Achieving anything below 15%, and I'd rather just hold an index ETF. 15% to me on a compound annual return basis over the long run is a sweet spot, and that means I can double my money every 5 years based on the rule of 72. Right? You take 72 as a numerator, you divide by the 15% return in the denominator, and you get 5 years, or 4.8 around there. Before I conclude, it's important to note that I am not too overly concerned with the price to earnings multiple, the PE, in the long run, as I am a growth at a reasonable price investor, GARP. This means that I'll invest in a company trading at a 30 PE if its earnings per share growth rate is 30% or greater, for example. I say this because most so-called value investors would just balk at that 30 price to earnings multiple and move on. Right? They'll call it overvalued. But please look into the price to earnings growth ratio, PEG. If I avoided companies with 30 price to earnings multiple over the past 13 years, I wouldn't have created much wealth at all in my portfolio. I would just be sitting on my thumbs waiting for a pullback and investing in the likes of Torstar and Chorus Entertainment, both being classic quote-unquote value stocks that teach one a very, very valuable lesson. Cheap stocks can get cheaper. Also notice that I don't invest at all in pharma, oil and gas, or mining. You won't see any of these industries in my 40 capital compounders. I call those industries capital destroyers, as all are cyclical, ebbing and flowing through the years with little cash flow predictability and hardly any sustainable wealth creation to be seen. Instead, I focus on and allocate capital to these three non-cyclical areas: technology, consumer, and diversified. And media can count as a diversified industry, like for example, Netflix. Further, I use return on capital. So that's ROIC, and you can go on Morningstar, you can look up their definition of return on capital, which I utilize for my own research purposes. I like return on capital rather than return on equity to ultimately base my investment decisions, as the latter, return on equity metric, can be inflated. It can look great, due to extensive debt leverage. I don't like debt, and I especially don't like companies that grow by excessive leverage. We saw what happened to Valiant, a pharma company. They grew on leverage, and a lot of their acquisitions just weren't as great as they seemed, and they weren't able to ratchet up the price as fast as they could anymore. And anyways, they ended up with like a 35 billion plus debt on their balance sheet. I much prefer companies that are self-funded through their own free cash flow, combined with strong, well-capitalized balance sheets, so that these companies are capable of funding growth and avoiding crashing in economic downturns. This very important return on capital metric that I use, I prefer to use ROIC rather than ROE, must be consistently high, which is why I use a minimum 5-year average, and above a company's cost of capital, and preferably rising throughout the years, combined with growing revenues, book value per share, earnings per share, and free cash flow per share. But perhaps most importantly, companies that I invest in, and all these companies in this group of 40 capital compounders, they all have competitive advantage, sustainable competitive advantage, so a moat around them, whether that be through the industries in which they operate, their operating models, distribution network, niche, and their products and services, regulatory advantages, patents, technology, and branding goodwill, etc. Durable competitive advantages allows these companies to compound shareholder wealth for a longer period of time, warding off competition for as long as possible. Anyways, guys, thanks for listening to the video. Please go to my website, robinspeziale.com. Take a look at this new blog. It's called The Next 15 Capital Compounders. Search up the original Capital Compounders, which has the original 25 stocks there. But now I'm combining both to make 40 capital compounders. Subscribe while you're on my site so you can receive email updates from me as I track these stocks. Happy investing. Have a great time. Talk soon.